India Ratings' stable outlook on construction is based on moderate growth expectations, expectation of a gradual improvement in profitability, and consequent moderate improvement in credit metrics. The sector is currently coming out of stress, with construction companies accounting for about 25% of the assets under CDR. However, there are green shoots. The aggregate interest coverage of the INRA sample of 20 companies improved from below 1 in FY15 to 1.07 in the first half of the year. And the EBITDA margins have also improved to 12.5% from about 10.5%. The improvement in performance mainly comes from those companies which have good liquidity, either in terms of a positive CFO or unutilized drawing power or both. Those with tight liquidity continue to struggle to grow business and may again be in financial distress. Overall, we believe liquidity would be the key driver for corporates in the construction sector in FY17. All companies will benefit from improvement in order execution. Better absorption of overheads will immediately result in higher EBITDA margins. Improved execution also means that the proportion of legacy orders, those which were bid during 2010-2013, that is a period of aggressive bidding, will come down, and the EBITDA margins of future execution will also improve as a consequence. In the short run, it will selectively be beneficial for corporates with larger proportion of fixed price contracts. But this advantage will recede gradually as the commodity price falls get factored into the new bids. This is no doubt a great opportunity for the sector. But given the weak balance sheets of construction companies, they may not be in a position to benefit from the opportunity unless a large equity is raised by these companies. Our outlook on real estate sector is negative, as the area sold by builders has been on a substantial downward trend over the last 1.5 years. The key cause is the run-up in residential real estate prices, which somehow tend to keep going up as the demand, despite a demand fall. This has resulted in the ratio of inventory to trailing 12-month sales of real estate companies going up, and consequently the cash flow from operation for most players in the sector is negative. Since this gap has to be bridged by borrowings, we believe the debt intensity of the sector will increase, leading to potential stress for real estate companies. Cement sector sells over 60% of its production to the real estate sector, and the demand growth from this segment is unlikely to be significant in FY17. The infrastructure sector, which accounts for about 20% of the demand for cement, is however likely to grow, and we believe that overall growth demand for cement in FY17 is likely to be above 5%. The capacity utilization of cement companies are likely to remain at the current levels of around 70%, and therefore our outlook for the sector continues to be stable.